Ever wondered what a balance sheet is and how you can read it? Well, you're in the right place. A balance sheet is a snapshot of a company's financial health at any given point in time. It's a crucial tool that business owners, investors, and financial experts use to gauge a company's assets, liabilities, and equity. This video is your guide to understanding and reading a balance sheet, even if you're new to the concept. So buckle up as we delve into the fascinating world of balance sheets. First, we need to understand what a balance sheet is. A balance sheet, simply put, is a financial statement that gives you a glimpse into a company's financial health at a specific moment. It's like a photograph of the company's finances. Now, this snapshot is made up of three key components: assets, liabilities, and equity. Assets are everything a company owns that has value, from cash and inventory to property and investments. Liabilities, on the other hand, are what the company owes. This could be loans, wages, or even outstanding bills. The difference between the assets and liabilities gives us the third component, equity, also known as net assets or shareholders' equity. These components are interconnected. They follow a fundamental equation: assets equals liabilities plus equity. This equation ensures that the balance sheet, as the name suggests, always balances. By now, you should have a basic understanding of what a balance sheet is. Let's move on to how to read it. Now, how do we read the assets on a balance sheet? A balance sheet displays a company's assets, and they're typically divided into two categories: current and non-current assets. Current assets are resources that a company expects to convert into cash within one fiscal year. They include cash, accounts receivable, and inventory. On the other hand, non-current assets are resources that have long-term value. These are assets that a company intends to hold for more than a year. They include property, plant, equipment, and long-term investments. Reading the assets section of a balance sheet gives you an insight into the resources a company has at its disposal. It's crucial to understand a company's assets as they provide a foundation for generating future cash flows and profits. So, the key takeaway is this: assets are resources a company owns or controls with the expectation that it will provide future benefit. Understanding assets is the first step in reading a balance sheet, but there's more. Next up, we have liabilities and equity. Let's start with liabilities. These are obligations or debts that a company owes. They're categorized into two: current and long-term liabilities. Current liabilities are debts due within 1 year. These could be accounts payable, accrued expenses, and short-term loans. On the other hand, long-term liabilities are debts due after 1 year. These might include bonds payable, long-term loans, or deferred tax liabilities. Now, how do you read this? Simple. Look at the numbers. A high amount of current liabilities compared to assets might indicate potential cash flow issues. A company with high long-term liabilities might have high borrowing costs and could be seen as risky. Next, we move to equity, also known as shareholders' equity. This represents the residual interest in the assets of an entity after deducting liabilities. In simpler terms, it's what's left for the owners after all debts have been paid. It's made up of two main components: paid-in capital, which is the money shareholders invested, and retained earnings, which is the profit kept by the company instead of being paid out as dividends. Reading equity is straightforward. A high equity balance suggests a financially healthy company. It indicates that the company has been profitable and has reinvested those profits back into the business. That's how you read liabilities and equity on a balance sheet. Just one more thing before we wrap up. So, what have we learned today? We've delved into the world of balance sheets, unlocking their secrets and learning their language. We've discovered that a balance sheet is a financial snapshot, giving us a clear picture of a company's financial health at a specific moment in time. We've learned that balance sheets are divided into two main parts: assets and liabilities plus equity. Assets, the resources a company owns, and liabilities and equity, showing who has claims on those assets, either outsiders, liabilities, or the company owners, equity. We've also uncovered how to read these sections, understanding that assets should equal the sum of liabilities and equity, the fundamental equation of balance sheets. This knowledge, however, isn't exclusive to businesses. It's equally vital for individuals seeking to understand their personal financial status or making investment decisions. Remember, understanding a balance sheet is a powerful tool in making informed financial decisions. So keep practicing and you'll master it in no time.